Good morning. This is Barry Knapp with Ironside's Macroeconomics. This is the abbreviated version of our weekly video summarizing our weekly note, which this week was titled "Toward a New World Order," with credit to M&M for the title. The combination of the JGB sell-off a week ago, weakness in the yen after the BOJ meeting on Thursday night, Friday morning, and the annual Davos conference that we find ourselves poking fun at every year, got us to write this note, which was primarily, at least the bulk of the note, was focused on rebalancing of global trade and the massive imbalances. U.S. running $1 trillion trade deficits, China running a $1 trillion trade surplus, and the incredulousness of the denizens of Davos that the U.S. was willing to abandon this post-war order, which we've come to realize over time was little more than a unilateral disarmament on the U.S.'s part of barriers to trade. The rest of the world, continued with non-tariff barriers, with tariffs, and the U.S. just allowed the rest of the world's export-driven economic models to build, while the U.S. just absorbed those. There were clear benefits to that, but they were diffuse, and there were some really acute costs, and politically it became unpalatable. And from a national security economic perspective, it's also really untenable and was unlikely to continue. And we've suggested in the past reading Doug Irwin's Clashing Over Commerce, so you understand the entire 250-year history of U.S. trade. The post-war order was more the exception than the rule. Whether you think this is the right thing or the wrong thing is irrelevant. We think it's absolutely inevitable. So one of the ways we wanted to provide some perspective on the implications for the markets, because one of our key themes for this year has been that the implications for capital markets, for global capital flows, is underappreciated if the U.S. trade deficit is going to shrink throughout the course of 2026. There are going to be real profound impacts on capital flows. And what happened to the JGB market and dollar yen is just a manifestation of that. We expect to see more of that through the course of the year. But we went back and we discussed the conundrum period. And one of the fascinating elements of that, so 2004 to 2006, the Federal Reserve was tightening rates from 1% to 5.25%, yet the yield curve just relentlessly inverted. Alan Greenspan called it a conundrum. Ben Bernanke called it the global savings glut. One portion of that episode came from October 2003 through March of 2004, when the Japanese intervened to the tune of purchasing about 340 billion US dollars. At the time, the US economy was strengthening quite notably, yet the 10-year Treasury yield fell from 4.5% to 3.7%. But that decline ended the day after the last intervention by the Bank of Japan into the exchange rate market. So you could just envision what that might mean now that the yen is weak and it's no longer in Japan's benefit to have a weak currency, and they start reversing this policy, what that means for demand for treasuries. Now, we're arguing that Europeans are not going to sell treasuries because they are mad at President Trump over Greenland or any other issues until they start running trade deficits, which, given their dealings with China right now, they may find themselves running trade deficits before too long, and no longer running a surplus with the U.S. But nonetheless, that's not the big issue here. For us, the bigger issue is where do those reserve assets go, gold is big part of the story, and we cover that in the note. And the dollar, we do think the dollar will get weaker through the course of the year, but we're more concerned about currency reverberations in the rest of Asia. Korea's got a weak currency right now, and Treasury Secretary Bessett's not really going to tolerate a weak currency. So, pardon me, this is what the note really went through. We then got into domestic issues around inflationary implications, which are quite small and overstated. And then reviewed the FOMC meeting this week, which will obviously have a lot more to say. But at this point, we'd have to say, with respect to the FOMC meeting, that Chair Powell's wanting to promote his legacy is going to delay our second big theme for the year, which is the privatization of the Fed's balance sheet, regulatory relief, a steeper yield curve that increases bank demand for treasuries. And that does increase the risk, because of that delay, of a real rate shock of 10-year Treasury yields going to 4.5%, driven not by inflation expectations, but driven by real rates going to something like 2.25%, a level that we think would probably be enough to trigger roughly 10% correction in the equity market. So that was our call. You all read our outlook note. We did think that we'd get into some trouble with the back end of the Treasury market, not because of inflation in the beginning of the year, but because of supply-related issues, strengthening growth, demand for credit, and there's a couple of interesting ways to position for this, which, if you want to read all about that, you should consider becoming a full paid subscriber to Ironside's Macro. It's never different this time. Have a good week, everyone. Thank you.